G'day guys, it's Ben and Ads here from Pumped on Property. Now, there was a pretty scary piece of information on the news the other night where the guys at A Current Affair were talking about a 40% drop in the Australian property market imminently and immediately. And why we've recorded this video today is because we think it's complete BS, and so do the guys over there at CoreLogic. Now, the reason I love CoreLogic is they're Australia's leading property analyst and probably, I suppose, from a data perspective, by far the best aggregator in Australia. So they've produced a really interesting article a couple of days ago where they talk about the Australian property market and previous cycles, as well as some of the negative things going on right here at the moment, as well as some of the positive things. So Ads and I are just going to walk through our interpretation of what they were saying and to sort of talk about where things are going as well.
G'day guys, Adam here. I guess I'll kick us off with starting it.
Yeah.
Or where do we want to go from here? Okay, cool. So I guess today we want to try and keep it a little bit more relaxed and a little bit more of a conversation. So hopefully we don't get into an argument about something, but I think
we're both... It's a good chance we might.
I think we're both on the same page with this one though, that there was some great information in the article and it did highlight a couple of things that we thought was worth talking about. To kick us off, I think we would be best to start with the current opinion and really the sentiment in the market at the moment, which does seem to be quite negative. From our opinions, it's a somewhat, not surprising is not the right word, but it's hard to align with that at all the times and to the extremes that people are saying. A couple of the points raised in that article that really hit home with us as far as the negatives go, and these are true facts, like you can't get around them, these are data, and that dwelling values are down in certain capital cities. Now, I don't know if you want to touch on that, but do you see that as the whole entire Australian market, or do you think that's just isolated to your major cities at the moment?
Look, I think it's having a knock-on effect to everywhere else in Australia, as we know. So people are, people, and people follow other people, and when the media is this negative like it is at the moment, and there's stories like the one the other night, it does scare the shit out of people temporarily. And what you've got to do is differentiate where you sit with that. But when Sydney and Melbourne are in a state of decline, everybody else in Australia takes a bit of a stock take, and that can have a knock-on effect to other marketplaces. Obviously, Perth and Darwin have been down for quite a while as well now since their 2013-14 peak. So, it's probably going to have a knock-on effect in terms of sentiment elsewhere, and a slowing effect in Brisbane and Canberra and places that were probably at a better stage of the cycle, according to Her and Todd White. So we'll just sort of play that one out by ear, but I don't think it represents the true value of that market. I do believe that Sydney and Melbourne personally were completely overcooked, and APRA did the right thing by stepping in there. I just don't believe that just because Sydney and Melbourne are 13 times average household income, Brisbane sitting at 4 to 6 times can be put in the same box.
Yeah, definitely. And I love that people tend to use averages in these conversations. So it's like the average household income across Australia versus the average property price. We know, like, if anyone studied statistics or knows anything about it, an average is a terrible way to try and work out how that's actually affecting people's lives and what sort of, I guess, statistical trigger that is to figure out the rest of it. I just don't, I don't think average is the right choice personally, and it does distort people's opinions and it does distort the data. So I'm glad you touched on that, but we'll keep going back to what the plan was.
Look, so before Adsy started in the property space, he was actually studying engineering at uni, and so we always laugh about just how misinterpreted numbers can be and how numbers can be used to paint a picture that is so far away from the truth at all.
Definitely. Like, we both learned at uni that it's one of the first things when you read any article or any piece of news, you got to pull it apart and ask the questions: where is this data come from? What's been applied to it? What statistical methods have they done to analyze that data? But yeah, we don't want to go too far down that track.
So I suppose sliding into another negative thing that's occurring at the moment from a sentiment perspective is rates are moving up. I think they've moved up by 0.15%.
Yeah, 15 basis points, and I don't think all 4 majors have passed that on or have followed trend.
2 or 3 out of the 4. But
yeah, 3 last I heard, so the 4th's probably coming, to be honest. But when it's a 0.15% increase, it's I know people that are really struggling to make ends meet, that can hurt. That $10 you're losing each week from paying that extra interest going towards your loan. But you got to think about it that way. It is $10 a week. Like,
yeah, it's a couple of cups of good coffee a week.
Yeah.
You know.
Saying that's off a $400,000 loan, and a couple of quick little, I guess, really simplifying that one down. But yeah, in most situations, that 0.15% isn't going to put people in harm's way, I don't think. And another important factor is, when I was broking, which I did previous to starting here at Pumped On Property, most of the time you'd be accounting for up to 7.5%, even up to 8% with some lenders, that they force us to apply to the calculations when we decide on how much someone can borrow. So unless someone's fudging the numbers or playing around with that, it should line up that they can afford these rate increases, and they can afford a few more to come if that is what ends up happening.
And what we've got to be aware of here is, you know, yes, there's a media story to say that rates have moved up, but we've got to remember that they're historically low rates. The last time we had rates this good was in the 1960s. And we've also got to remember that, you know, 0.15% isn't anything to write home about. It's just this story is selling at the moment, and so people are sort of jumping on that bandwagon. I remember when I was buying my first properties in 2011, a 7% rate was a good rate at that time, and that was completely the sort of, you know, rate of the day. There's no statistical correlation between a rate increase and a drop in property prices over the last 50 years according to RP data. So get to know your history before you start, you know, buying the hype.
Yeah, 100% agree. And like you've just touched on there as well, in the moment, at this point in time, I think we were previously at historical lows for people in arrears on mortgages. Don't hold me to that, but I think that was the case.
Yeah, so that's what RP's come out and said.
Yeah, so we've moved a little bit off that, and they're saying we're at, I think, 6.6% of loans are in arrears past 90 plus days, and that's the kind of figure that they decide that's when things start to be in trouble, is past that 90 days, and it's when a bank starts thinking about, do we need to do something about this? So
to think about that for 1 second, we're talking about less than 1 out of every people are having an issue paying their loan after 90 days of arrears right now, which is
less than 1 out of 100.
Less than 1 out of 100, shit. Less than 1 out of 100. Like, it's a ridiculously low rate, historically low rate. We've never seen it that low in Australia before. When people got in big trouble in America in the GFC, it was because we're not talking about less than 1%, we're talking about 5, 10, 15% of people, 20% of people America-wide were defaulting on their loans, and that's obviously has a huge knock-on effect throughout the system. So yes, there's going to be more mortgage pressure as people go from interest only to principal and interest loans, or as rates move, but you know, that's why as an investor, I think we take the approach of a long-term strategy, have a buffer in place if you can, and tuck a bit of money away for that rainy day, so that you're not one of those people that's forced to sell if, you know, the worst case scenario does happen. Yeah,
and just to jump in there as well, when you mentioned about America, their lending practices at that point in time are laughable, as you've seen on movies, documentaries, everything about it. Like, from seeing what Australia was doing leading up over the last couple of years, we are not even close to doing what they're doing. So when people are coming out saying that, oh, there's dodgy things, there's this going on, there may be, but it's nowhere near to the extremes as what we've seen in America. And most of it comes from people potentially lying to their lender or lying to their broker, not from a broker or a bank's perspective, not doing the right thing by you. So I think we are in quite a strong position from a lending perspective, even though a lot of people do see some negatives around that at the moment. But I guess moving on from that side and from the lending space of things, we can talk about debt just as general, and we've seen that household debt is up from previous times, apparently. But once again, like, I would like to see the process that's decided, how this data is put forward and how it's analysed, because I still don't see how they're coming up with some of these figures, and I want to know how they're calculating these things and where they're pulling that information from. Not taking apart any of the experts, I'm sure they've put a lot more time in than I have researching this, but I just would like to see what they're doing to come to the numbers that they do.
You know, when they say Australians are at the highest level of household debt in history, obviously property prices are more expensive than they've ever been, and property prices as a reflection of wages are probably higher than they've ever been in Sydney and Melbourne, which I think is where 40% of Australia's population lives. So what we do with these averages is we get caught as Australians when really we're talking about a percentage of people that are overexposed in Sydney and Melbourne that may have got dodgy loans written for themselves or with the help of a broker, or may have bought in between 2016 and today, or maybe 2017 today, that bought at the top of the cycle that can't really afford it, that are going to get caught out if things are to go south. But for people that have been in the game for 7 years, you know, you've probably got 50-60% equity in your property in those states, and your loan's low, and you've probably been paying principal and interest over that period of time too. You know, we're not, when we get caught up in averages, we just miss what is happening on an individual level. And yes, there will be a percentage of people overexposed at any time in any cycle, good or bad. It's just, you know, make sure you're not one of those people.
Yeah. Exactly, just be smart, understand what you are comfortable being able to maintain and what you're comfortable being able to borrow, and what sort of levels that you know you can make. Like, I think whenever we talk about these averages, it's an important indicator, but it's just, you got to be wary of what it's actually indicating. Is it the correct reflection of the information you're trying to get across? But we've digressed a little bit from talking just about that article that we both enjoyed reading, I think.
Yeah, like, I love the article, and it was really nice to just get a different perspective. And you know, that's why subscribing to RP Data's weekly stuff is just so helpful, because they do both sides of the coin based on data, and they look at longer term trends as opposed to, you know, what's happened in recent history.
Yeah, and like, one of the key things that I really took out of that article was the fact that can't remember both their names, but Martin North in particular came out saying that he was taken out of context. So it was, yeah, he predicted there could be a 40% downturn, but I think, what was his likelihood for that one? I think
he said 20% likelihood. And again, like, how do you put your head in the sand and go, it's going to be a 40% drop, and then go, the likelihood is, you know, 20%. I'm not saying that it can't happen, because all possibilities can. All I'm saying is that, you know, how do you even
How do you identify that risk? So, like, we know what the issue is that could potentially happen, but how do you decide that it's a 40% downturn and it's a 20% likelihood? Like, it's just...
Look, as a property investor, personally, a 40% dent in the marketplace would have huge ramifications Australia-wide, and it would completely rock the Australian economy. It also is an incredible opportunity if you're sitting outside of the markets that are dropping by 40% to capitalize on that type of opportunity too. So, you know, as like the screensaver on my computer has from Charlie Munger, who's Warren Buffett's business partner, says the money is not made in the buying and selling, the money is made in the waiting. And as investors, it's our job to take advantage of conditions when they're solid, and put ourselves in great positions to take advantage of them when other people aren't. And that is why I love Brisbane so much at the moment, because you've got this short-term thing where people are sitting on the sideline, but long-term it looks very, very, very interesting to me, which is digressing again.
Couldn't help ourselves. Yeah, so we did digress a little bit again, but it does bring up a good point. Like, the high proportion of investors that a lot of people are worried about, we know that there's a much larger number in Sydney and Melbourne, and that's where we're really identifying the issue. Like, if you look at Brisbane, like, sorry, once again, I don't know the numbers off the top of my head, but I believe the ratios of investors, I think, is falling somewhere in that 25 to 30% mark.
Yeah, maybe just
correct?
Touch over 30%.
Okay, a bit over 30%. So, like, if we look at that compared to Sydney and Melbourne, which, once again, is that up around the 40-50% mark, is it?
Yeah, so I think it has been sitting at 55% in Sydney at the height of this whole craziness over the last few years, and it's peeled itself back to somewhere in the 40s and is trending lower. But, you know, as those investors start peeling out of the marketplace down there, that is one of the risks that they identified in the article, which was, you know, there'll be a further softening of the marketplace, which, again, a further softening to me is fantastic news. As much as people might not want to look at that, you've got to remember that over 50 years, Sydney's gone up on an average of 9% per annum. if you're holding for the next 15 years, things are going to be fantastic. It just might be during this period of time that you wash off, you know, 15% of the property value that you have.
Yeah. And like, we know that markets move through a cycle. It's just a natural part of it. And without a downturn, if something's just constantly going up, it tends to be unsustainable, and there's going to be an even bigger crash that happens eventually, which I know this is a point that you wanted to touch on, and people do act like that's what Australian property's previously done. Like, it just doesn't stop moving up. What's your thoughts on that?
Yeah, so we actually printed this out from the article, and you probably can't see that very well. But effectively, what they looked at was the historical peak to trough decline. So let's say that what that means is effectively we've just gone through a peak, and now it's obviously naturally corrects, because we've always got to remember at the peak of any marketplace, whether it's stocks, Bitcoin, property, gold, people go feral at the end because they feel like they've missed the boat and they want to buy before it's too late, or that everyone else is buying and talking about it and making such easy money. So you get this franticness that you saw in 2016 in Sydney, and the franticness that you saw in 2017 in Melbourne, where silly people overpay too much because they think that the ride's never going to end. Yep. But the ride always ends, and that little peak at the top's called the winner's curse, and effectively from there prices correct a little bit. Now if we look at 1, 2, 3, 8 periods in Sydney in terms of when it's achieved its last peak in the last 33 years. It's funny because it starts on the year that I was born, 1985. You know, we've seen prices drop at the top of these markets in Sydney somewhere between 3 down to about 11 or 12%. Yeah. So it's completely natural for a marketplace to go, holy shit, we're expensive. And then for the media sentiment and the sentiment in the marketplace to change, and then for things to naturally slide. And the exact same things happened in Melbourne. You might or might not be able to see that, but you know, again, from the historical peak, it's gone from, you know, -1% down to -9% as well, with everything in between. So I think it's just important to remember that it's completely natural for markets to correct, and you know, stuff goes up and stuff goes down. Sometimes it just needs a correction to come down, and then it will go flat for a period before, you know, it does whatever it will do in the future again.
Yeah, and I want to touch on that just really quickly, not to digress too much, but we are investing. Investing's like,
remember that.
Investing's not, like, in my opinion, investing's not about the short term, or otherwise you're just working. Like, you can do any sort of action and effort to create an outcome that you want. Yep. Investing's the idea that you're thinking a lot further down the track, and you're putting work in now to get an outcome later on. So if there is these downturns, if there is these corrections, it's all normal parts of the cycle. And as long as you're not buying at the top and then selling at the bottom and really copying the worst extremes of it, you should be fine to ride that out. And it goes back to some of the other points we touched on earlier, and that's just make sure that you're not putting yourself in a position which you don't think you can handle that in the future.
And remember, the top of the 1985 market in Sydney was a property price average of maybe 80,000 bucks. You know, like, people probably thought that was expensive, and they were fearful when property prices went down by 3 or 10% at that time. But you know, if it's a 30-year buy and hold strategy, you're going to be all good, whether you bought at the top or you bought at the bottom. Obviously, we recommend that you get educated and buy at the bottom, and take advantage of the cycle and take advantage of the information available to everyone. But you know, whether it's top or bottom, as long as it's a 15 to 30 year strategy, you, your family and the people you care about are going to be exponentially better off.
Yeah.
As long as you don't get forced to sell at the wrong time.
Agreed. So you actually invest in property.
Yeah. I think because we've just gone through this craziness, a lot of people have this mindset that you just get rich really quick in property, and that everything you buy should go up by 50 or 100k per year.
Yeah, and hence, like you touched on before, and that's how we create the winning curse, or the winner's curse, sorry.
Yeah. So, you know, just to finalise the negatives before we talk about some of the positives in that article from CoreLogic, you know, it has been very similar to previous downturns, and it's sort of sitting right in the middle of not the worst digression, not the softest either, which again, it had to happen. And it's also not the strongest boom we've ever had, although a lot of people, you know, say it is, because we've got this recency bias as investors that we all carry around, which is whatever just happened was the best or the worst of all time, and we forget that there's been 2,000 years of civilization or 100,000 years of civilization before this point. But yeah, like, it is completely normal, and take everything with a grain of salt, including what we're talking about in this vid.
Yeah, definitely. So just, I guess I will finish off on a few of those negatives. So you've got Sydney, I think the report was saying 5.6%. It's regressed by. Melbourne sitting somewhere in that mid 3% range as well. So if we look at what Ben brought up before in those charts and where the averages are, where Sydney's regressed from between 3 and 11%, and same with Melbourne, I don't think it was quite as extreme as that. I'll just double check. Yeah, in one of the scenarios it was really quite low at 0.3%, but we could call that an outlier, and then up to 9.3%. So if we look at where we are now, which is, say, a correction, those 5.6 and 3.4, we're smack bang in the middle of really where it could be, or maybe even on a bit more towards the less extreme size of where we are. But obviously there is still a little bit more to go, or could be to go in this one, so we don't know where it'll end up. But just to highlight that it's normal, like it's lining up with what's happened before. Yeah, household debt is a little bit higher. Yes, supply's gone up in some areas, and they're like arrears and mortgage rates are starting to go up a little bit, but they're still close to historical lows. So I don't know, like, there's a few negatives there, but I still don't think it's as quite as dire of a situation as people make it out to be. What
you've got to remember with all of this is, why are we actually in this right now? Like, why are prices in Sydney and Melbourne going down? And when you ask that question, there's one reason, and that's the Australian government set up a governing body called APRA because they needed to put the brakes on the marketplace, otherwise the entire Australian economy would be shot. And because we were too over leveraged in property, or we still may be, and there's a contraction period that comes as a result of that. But this wasn't driven by unemployment rates being 10%, or a global war, or America's whole marketplace stopping, or a population decline, or massive sickness. This was driven by the bank being forced down a path which is, we're going to stop lending because it's now responsible lending in Australia. And instead of looking at the rates at 4%, which they are, we're looking at the rates at 10%. And instead of a 5% deposit, we now need a 10 or a 20% deposit. And instead of a interest-only loan, it's now principal and interest. And instead of assessing your full income and the full rent return, now we're only going to take into account 80 to 70%. Now, as an investor who hates risk, I fucking love that. Like, I love what's happened, but don't get caught up that this is happening for any other reason outside of it's hard to get money right now. There's no other reason that the Australian economy would naturally be heading this way outside of it's just perfect timing if you understand the history for the mid-cycle slowdown. And it's also enough's enough. Like, things just don't run forever, and market sentiment changes, and money's harder to get, and when the contraction of money comes, the contraction of investment spending goes as well.
Exactly, it's supply and demand. You reduce the demand by taking out a proportion of investors that were over leveraged and stop them from being able to borrow some more. You're reducing the demand, creates more supply, prices have to reflect that accurately, and it'll change a little bit. But like you touched on, I don't, like, it's not a population issue, which is a major part.
Almost 400,000 people moved here last year.
Yeah, so like, if it's not a population issue, we've seen that APRA's put these policies in place or tightened up some of the policies that already existed, and it's going to have an effect, and we're seeing that effect now. Like, people talk that these things have just happened. This has been in play for a while now. Like,
I've noticed it in my business since 2005.
Yeah.
The first round of changes came in 2005 and stuff went vroom. And then investors came back into the market because they dropped rates.
Yeah.
And then boom, and then the second wave of changes were 2016, and then this is just the result of those changes 2 years ago.
Completely agree.
Yeah. And yeah, I mean, you're a broker, bro. You saw it harder than anyone else.
Yeah.
Like, it's great stuff for me personally to be able to sleep better at night.
Yeah.
It's just, scary because it feels like it hasn't happened, but if you know your history, it's been happening forever.
Definitely. And one thing to touch on too is, like, you say you like it. Me too, I love it. It means, like, as a broker, I feel comfortable borrowing up to my maximum borrowing capacity because
I'm conservative.
But like, I know, like it's nice to have a little bit up your sleeve for whatever might come. But to me, that's cash savings. That's your buffer that you have in place. Borrowing up to your limit in the right times, you're trusting that the banks have got your best interest at heart, which I know is a little bit scary and you wouldn't think so, but they have to stay within APRA's regulatory guidelines, who do have your interest at best heart. So they're doing what's best for the overall market and yourself. So like, you can push the limits up to what you can do. Well, that's my opinion. I know Ben's got a different strategy.
I've got a different opinion than that, man, but yeah. I mean, I'm super conservative, but I wasn't always that way. Like, you know, I did buy 11 properties in the last 9 years, so that would be, to some people, very, very high risk. I probably wouldn't have gone as hard as I did now, or knowing what I now know, I probably would have gone harder because things went so well. But, you know, wherever you sit between where Adam's at and I'm at, as he said, like, the banks are super conservative right now, and then the Australian government's forcing not just the banks to be conservative with us, but the banks to be conservative themselves.
Yeah.
And their lenders to be conservative, and their mortgage brokers they're using. So it's good stuff. Like, so many people can borrow money right now, just not the people that are fully overexposed or that shouldn't be able to afford it.
Are you pointing at me there?
No, this is just a thumb in the air. Yeah. So yeah, I'm borrowing money. I'm buying stuff at the moment in southeast Queensland. So's Adam. We have no problems. We're so excited about that. There's some amazing deals around. It's just, you know, Sydney and Melbourne aren't my first choice right now.
Exactly.
Maybe after the next GFC they will be.
Yeah, completely agree. I guess we've talked about negatives and tried to put another side on a lot of it, but we'll just run through, not quite as long as what we spent on the other side, but talk about a few of the positives that were touched on in this article and where they went. So we've said this similar to previous downturns. We've kind of touched on population growth, but I think that's a major part which isn't talked about enough at the moment. And Australian property is, it's just like, well, certain people say it's underpinned by our migration policy, and what it's allowed us to do is, although our natural birth rate isn't quite as high as what it would be to keep up a very aggressive population growth, what we allow is immigration, or our migration policy, to allow a large enough number of people coming in to keep that demand and supply and demand ratio to right where we need it to be to keep this going. So without seeing any changes to our population growth or our migration policy, which the article touched on, both political parties are agreed that
they see eye to eye on one thing, which is immigration.
It's important, and it's not changing at the moment. It's not planned to change, and from what we're hearing, it's going to stay the same. So
I think the 2050 vision for Australia is 60 million people.
Yeah.
Now, I don't know if that's right. It might be a longer term period of time, but 60 million is where I think they want to be within the next, maybe it's 50 years, sorry, not 2050.
So where do those people go? Like, where do you see them all ending up?
Well, Michael Matusik and the Australian Bureau of Stats say that 25% southeast Queensland, 25% Sydney, 25% Melbourne. So I'll just follow where the ABS says the growth is going, and I'll roll my dice investment-wise into those markets for sure.
Yeah, definitely.
Yeah.
And like, one thing is, like, those people coming into southeast Queensland, Sydney, Melbourne, that also creates a flow-on effect of internal migration within Australia to different areas as well. I won't go into that too much right now. We'll keep on topic. But going further down that list, I like the Moody analytics that they brought up, that the CoreLogic do. Do you want to touch on that a little bit? Yeah,
so Moody is effectively a gatekeeper. If you've seen The Big Short, I think they're one of the 3 biggest aggregators in America as well. They've always had a conversation around doom and gloom, or boom and bust, which regardless of what marketplace, and they give different markets around the world different ratings effectively based on different times of the cycle, and their rating for Australia a couple of years ago was pretty accurate in terms of what's happening now, but their latest report has identified that from about 2019 they expect everywhere, all the major capital cities in Australia outside of Hobart to record positive growth of somewhere between 0 and 3-4% depending on the area. So these guys have a pretty big vested interest. They sell those reports for Australia for about 1,500 odd bucks in making this stuff accurate. That's their business model.
Yeah, so would they do better if property prices went up? Not necessarily, it's just whether or not their information's correct.
Yeah, like, people are measuring the market versus their result.
Yeah. So a couple of things that they touched on that why Moody Analytics thinks that we're still in quite a positive state was that business investment, or like investment into business in Australia outside of the mining sector, has increased. Infrastructure spending's increased, job growth's, you can question whether it's full-time, part-time, how that's actually growing.
But there might be a bit of manipulation there.
Yeah, there might be a little bit, but jobs growth still says it's up, and interest rates are still close to historic lows. Whether or not they have increased by some basis points off the bottom, 15 now, might have been a little bit of an increase earlier in the year, but it's still at record lows. Like, let's be honest, you can still go out, get a home loan for your own place well under 4%, and there's still even some investment rates out there around that 4% mark, which is fantastic.
Ridiculously good.
So thinking of those few factors that Moody's kind of hung their hat on as why they're happy to say that we're in a positive space, to me, I completely agree. Like, those are the important things. One thing that they didn't touch on too much was that population and where we're at and where that population growth's going, but as we've touched on earlier, I think that we're in a positive space there as well.
So I think, looking forward in terms of some of the things they talked about to finish the positive sentiment side of things is, the RB, or the Reserve Bank of Australia, has a cash rate at the moment of about 1.75%. Now, it's not as high as I'd like it to be personally. Like, it would be great to see that at 2.5% or something like that, which I think is where the American rate's heading at the moment. But that does give us 1.75%. You've got to remember that some of the banks, like the Bank of England and some of the American banks, cut their cash rate to effectively zero. Some of the major banks like HSBC and the Bank of Japan cut their rates to literally 0% or 0.5 of 1% for the investors in those markets to stabilise the economy and to stop the bleed.
Yeah.
So we do have a little bit of wiggle room there for them to further cut rates back. And while the banks are grabbing their profit right now because they're not getting as many investors into the market as they were, they are still, seeing rates sitting at 4%, remembering that rates with some of the biggest banks in the world went down to 0, 1 or 2% in the bigger countries like England and America, is a positive, like, ace up our sleeve. Another really positive ace that wasn't included in that is the fact that the Australian government's debt position, while it's not amazing, is significantly better than almost every other developed country in the world right now, and trending in a more and more positive direction. So, those two things are, partial reasons we got through the last one. And, I'm not saying we're going into one right now either. It's just nice to have those types of things up our sleeve. Mining's starting to really crank back up at the moment, so is infrastructure spending.
Yeah. So I think that really covered off on a few of the, I guess, positives that we've seen. Another one that they did bring to light is that in Sydney and Melbourne, investments actually have gone down, which we touched on at the start.
The number of investors in the market.
Yeah, sorry, the percentage. So where it was at 55%, that's dropped to 41%. So that also means that the owner-occupied side of things is also gone up 15%, which we know is a great thing in the market. Well, not necessarily a great thing that it's going up, but we knew it was out of balance, and so this is correcting to back to where it needs to be. I'm not sure where that happy medium is going to be and where it finishes off, but we are tracking in the right direction, and it's just going to be a matter of time. And like we've touched on a few times throughout this, it's a supply and demand thing. So if there's issues that come up in the future with housing demand, or people that need to be in houses, or rental prices being too expensive, all these sort of things that can come up, then it can go either way, I guess, is what I'm trying to say. I'm getting a little bit lost here. It depends on the rest of the market and what's happening in the rest of the economy to where that goes. So
yeah, there's so many things that on a big scale and a smaller scale that affect local property prices, but Adzi hit it on the head. It is all supply and demand, whether on a global thing that has got to do with sentiment, or it's got to do with the flow of money or political instability, or at a local level, physically there's 30 people rocking up to every open home on a weekend, and there's only 10 properties for sale in the suburbs. So all of these things are things that you can start to learn. A couple of really cool resources is obviously the RP Data's weekly and monthly updates, which I recommend. Hare and Todd White produce a great free report as well that you can Google and take a look at where, the place in Australia that you want to invest is at right now. The great book that I always recommend is The Secret Life of Real Estate and Banking by Phil Anderson, which looks at 250 years of history in America. You've got Fred Harrison's book, Boom and Bust, which predicted the 2007 recession before we had it. And his other book, The Power and the Land, which predicted the 1990s recession 7 years before we had it. So there are people that understand this stuff in a big way, and your job is to just take little snippets of ideas from everyone and then, you know, try and make up your own mind.
Yeah.
One thing I will say, bro, like as you learn more and grow more, like what are your personal plans for the next 5 years in terms of investing, and how are you using market cycles and timing to plan for that future? We haven't planned for this question either. I've just thrown that one at him.
Throwing this on me. But that's completely fine. My plan's relatively simple at the moment. It's do what's within reach as well. I know there's always out there you want to make that perfect first step, and there was that perfect first step out there, but you got to weigh up time frames and where that is. And unfortunately I had to I sped up my plans a little bit to make it work within cycles and things that I've researched a bit more recently and that Ben's helped me learn as well. And so with all that new information, I've kind of changed my plans slightly, but essentially it's over the next 7 years. I'm focusing on southeast Queensland. I might go a bit further up north into North Queensland as well.
Okay.
I'm not committed to that yet. And
gambler.
Yeah, that one's a little bit more of a risk. But at this stage, it's focusing on southeast Queensland, and then looking for that in that 7 years, maybe a bit sooner than that. I'll then look to try and start focusing on other markets, particularly Sydney and Melbourne, where I still see there's a lot of potential there. Where, like, it's obviously, we've seen that peak and everyone gets scared away from it and think property prices can't go anywhere from here. But as we've talked about a lot, there is downturns. They are a part of the property cycle. And so when that next one comes around, I'd like to be in a position to capitalize on that opportunity and buy in Sydney and Melbourne. Yeah,
for sure. And my strategy is not dissimilar to Adam's. At the moment, it's consolidating debt and repaying some debt. It's also finishing a subdivision that I'm going through at the moment in Brisbane and building a property. On one side, I've just sold the other piece of land, so I'll be building a house and a granny flat attached to that one. My wife and I are renovating our home at the moment to put some more equity into that one too. And then I think my strategy will be a combination over the next 7 years of, you know, buying really high quality houses close to the beach or close to the city that I can get that dual income on for cash flow, as well as maybe doing a little bit of short-term buying, renovating or building and selling for profit, and using those chunks of cash to repay debt too. So at different times of the cycle, you just want to hold everything. At other times, you know, your strategy can, you know, shift as well. So if that sounds interesting to you, you know, Ads and I would love to offer you a one-on-one strategy session where either myself or my brother Simon would sit down and talk about that a little bit further in terms of where you are, where you'd like to go, and educate you a bit further from our perspective on the Australian market right now. You know, everybody's got a different opinion, and we just want the best for you. And, you know, whether that's doing it on your own or with the help of somebody else, you know, you can make up your own mind on that one. Yeah, so thanks guys for listening in today. Really appreciate your time and watching this video. There is a lot of uncertainty out there at the moment, but hopefully this has helped to make the picture a little bit clearer moving forward. So tune in next time, and thank you.